Hare Krishna. Welcome to Tax Video YouTube channel. This is CA Rohana Pingai, practicing chartered accountant, based in Mumbai. Also, partner in Motilal and Associates LLP, member firm of Marks Net. Welcome to our video series, What Law Says. Direct tax, case laws, reported to ITAT and High Court, Part 6. So, let's dive into it. Let me allow to share my screen. What law says? Direct tax part 6. We will discuss case laws reported to ITT and then reported to High Court. Let's start. First case. New Dawath Traders versus ITO TS 119 ITAT 2025 Mumbai Tribunal Assessment Year 1718 Date of Order 14 February 2025 and relevant sections are section 270A and 270AA. Let's understand and fact an issue of the case. The assessee firm Messrs. Dawath Traders based in Mumbai is engaged in wholesale rice trading. Okay, engaged in wholesale rice trading. Filed its return for assessment year 2017-18 on 30th October 2017, declaring income of rupees 6,52,740. Survey under section 133A took place on 17th March 2017, following which AO expanded total income to rupees 55,46,812 after offering rupees 30 lakhs under PMGKY scheme. Net assessed income stood at rupees 25,46,812. AO issued reassessment order on 30th December 2019. The assessee paid tax and interest amounting to rupees 8,70,297 within 30 days of demand and didn't file any appeal. The assessee claimed immunity under section 270AA, arguing that since it paid tax and interest on time and filed no appeal, immunity should apply even though Form 68 was not filed within the stipulated time. AO denied immunity and levied penalty under Section 270A at the rate of 50% on underreporting for tax of rupees 2,72,549. CIT appeal confirms AO's order, holding filing Form 68 was mandatory for claiming immunity. Let's see what tribunal observed and held. Tribunal noted that the assessee fulfilled both the substantive conditions under Section 270AA, subsection 1, payment of tax and interest, and no appeal filed. The only failure was technical non-filing of Form 68 within the prescribed period. Means what was the failure is what technical non-filing of Form 68 within the prescribed trial. Tribunal emphasized substantial justice over procedural formalities, citing Supreme Court President Pankaj Bhai Ramesh Bhai Jhalawadiya, a minor or venial breach such as delayed Form 68 should not override the right to immunity which had vested on meeting substantive conditions. His right to immunity is a vested right and therefore the minor or venal breach such as delayed Form 68 should not override that right. Okay. The tribunal held that non-filing of 68 was merely a technical or venal breach and should not deprive the assessee of immunity. Since both substantive preconditions were met, no penalty under Section 270A should have been levied for underreporting. directed the complete deletion of the penalty. Means case law held in favor of the assessee. Very important. Next, Seema Srivastava versus ITO 2025, Patna, assessment year 2017-18, date of order 6th June 2025, and relevant sections are section 54 and 54F. Let's understand facts and issue of the case. Assessee filed a return for assessment year 17-18 declaring LTCG of rupees 2 crore 58 lakhs 34,383 and claimed exemption under section 54 mistakenly. Sale proceeds of immovable property included and capital gain computation along with purchase deed of new residential house in Delhi was submitted during assessment and appellate proceedings. AO disallowed claim under section 54, noting the sold asset was not a residential house and further held exemption under section 54F couldn't be allowed since no claim was made under section 54F nor fulfillment of its conditions demonstrated. CIT appeals rejected the claim similarly, holding that the assessee had neither claimed under section 54F nor provided details substantiating the eligibility. So issue was whether typographical claim under section 54 instead of section 54F disentitles the assessee from claiming the exemption under section 54F when the assessee is otherwise eligible and has provided the required documents and completion. Very important. Means we may face such issues because there may be a typographical error and therefore the department is depriving the right to the assessee just because of the typographical error. So let's see what tribunal observed and held. Tribunal noted that the clerical error in identifying the wrong section was inadvertent and the assessee had submitted computation, sale deed and purchase deed clearly evidencing eligibility under section 54F. Means in the first point only, the tribunal noted that the clerical error in identifying the wrong section was inadvertent, highlighted the settled judicial principle under Bohet's India Limited case that the limitation on claiming exemption in the return applies to AO, not to appellate authority. What the limitation on the claiming exemption in the return applies to AO, not to appellate authority, and thus CIT appeals can allow correct claim if the facts on record support it. When CIT appeals can allow the correct claim if the facts on record support it. The tribunal set aside the orders of AO and CIT appeals, held that despite the claim mistakenly filed under section 54, the assessee was eligible for deduction under section 54F since all substantive conditions were satisfied and evidence filed. Remitted the case back to the AO with direction to allow deduction under section 54F, allowing opportunity to the assessee to furnish any further evidence if required. Appeal was allowed for statistical purposes by the tribunal on 6 June 2025. So very important case. We may cross such issues because of any inadvertent error. We may face such actions from the department. So we must use these case laws for defending our clients too. Next, Dhruv Sanjay Gupta versus JCIT ITA number 5749 Mumbai Tribunal 2024. Relevant assessment year is 2013-14. Date of order 28th June 2025. Relevant sections section 56 to 7. 56 to subsection 7. Sorry, clause 7. Very sorry. Section 56, subsection 2, clause 7. Let's understand facts and issue of the case. The assessee got married on 8th December 2012 and claimed to have received gifts totaling rupees 2 crore approximately on the occasion of marriage. That is 2 crores from Sri Anil Kumar Goyal, first cousin on paternal side, by check dated 8th December 2012 and supported by a memorandum of gift dated same day. Rupees 11,35,000, approx USD 21,000 from Sri Siddharth Jatia, a family friend residing abroad, check and gift deed dated 4th December 2012. Although the checks were executed on those dates, the amounts were credited only later. That is 2 crore credit on 18th December, 10 days later, and 11 lakh credit on 2nd January 2013. The assessee claimed this as exempt under the proviso to section 56 to 56 subsection 2 clause 7 as gifts on the occasion of marriage. Issue was whether gifts received after the date of marriage, gift received after the date of marriage due to delayed check clearance can still qualify as exempt on the occasion of marriage under the proviso to section 56 subsection 2 clause 7. Let's see what tribunal observed and a very important case law. The tribunal emphasized that the phrase on the occasion of marriage should not be interpreted in an overly narrow or literal fashion based solely on the bank credit date. This will lead you what tribunal will hail in. Let's see, on the occasion of marriage should not be interpreted in overly narrow or literal fashion based on solely on the bank credit date. What matters is the connection between the gift and the marriage. That is whether the immediate reason for the gift was the marriage of the recipient, not the date of clearance. Immediate reason for the gift was what? Marriage. It held that the gifts were genuine, motivated by the marriage, and not sham or benami transactions. Donors had genuine financial capacity. There was no material evidence of fakery or artificiality. Therefore, assessing officers' fixation on check clearance dates was described as a microscopic and legalistic view at odds with legislative intent. The tribunal allowed the appeal in full in favor of assessee, deleting the addition. It held that despite clearance falling under the marriage date, the gifts were exempt under section 56 to clause 7 because they were linked casually to the marriage event. There is a linking, the connection is more important. The parliamentary intent behind the proviso was for a broad and purposive interpretation, not a restrictive one based on banking timing. Very interesting cases. Next, Clayking Minerals LLP versus ITA number 82, Ahmedabad Tribunal 2025. Relevant assessment year is assessment year 1819. Date of order is 27th May 2025. And relevant section is again section 56.2 clause 10. Let's understand facts and issue of the case. Assessee filed a return on 30th August 2018, declaring a loss of rupees 1,24,000 for assessment year 1819. Case selected for limited scrutiny by CAS regarding property value under section 56 subsection 2 clause 10. AO noted that the assessee purchased land that is rural agricultural in Ghanasham Nagar, Sosa, Kundal, Mehsana for 42,72,000, whereas stamp duty valuation was 1 crore 15 lakhs. The assessee contended that land was agricultural at purchase date, that is 21st September 2017, not a capital asset under section 2 subsection 14. Conversion to non-agricultural use happened later on 20th October 2017, registered on 26th March 2018. Issue was, does section 56 subsection 2 clause 10, that is inadequate consideration for immovable property, apply when rural agricultural land is purchased below stamp duty value? That is, does agricultural land qualify as immovable property for purchaser even though not a capital asset for the seller under section 2 subsection 40? Let's see what tribunal observed and held. The term immovable property in section 56, subsection 2, clause 10 is not defined in the Act. Thus, it must be interpreted in ordinarily or general parlance, meaning an asset that cannot be moved without altering it, including rural agricultural land, absent any statutory exclusion. The immovable property is not defined under section 56, subsection 2, clause 10, and therefore, here ordinary and general balance is important to get the meaning of. Section 56 to sub clause 10 refers to immovable property, not capital asset, and hence agricultural land excluded from capital asset under section 2 subsection 14 is still taxable in buyer's hands under section 56 to clause 10 for difference between stamp duty value and purchase price. Characterization depends on intention and use, not merely revenue records. What revenue is recorded is not important. What is important is the characterization is important, depends on the intention on use. What is the intention and use? Since conversion was intended early, AO's classification was justified. Here, conversion was intended early, so AO's classification was justified. Since assessee disputed the stamp duty valuation, A was required to refer the matter to the Departmental Valuation Officer, that is DVO, under the proviso to section 56, subsection 2, clause 10. Reference to the DVO is mandatory, as held in earlier ITAT rulings, including Dilip Manibhai Prajapati case. The tribunal allowed the appeal for statistical purposes and set aside the addition under section 56 to clause 10 regarding rupees 72 lakhs. It held that agricultural land qualifies as immovable property under section 56, subsection 2, clause 10 from purchaser's perspective. Okay. Agricultural land qualifies as immovable property from purchaser's perspective. Directed the AO to refer the property's valuation to the DVO and reassess accordingly. Appeal was allowed and remanded to AO for fresh valuation reference to DVO. Next, Teacher Retirement System of Texas versus ACIT ITA number 137, Mumbai Tribunal 2025. Relevant assessment date is 22/23. Date of order is 23rd May 2025 and relevant section is section 70 subsection 2. Let's understand facts and issue of the case. Assessee registered as a foreign portfolio investor in India, filed income return on 26th July 2022, declaring total income of 1,392 crore. During cash scrutiny, that is systemized, it was found that the assessee suffered a net short-term capital loss of 1,362 crore on transactions subject to STT and earned a short-term capital gains both on STT paid and STT not paid transactions, aggregating net short-term capital gain 312 crore. Assessee set off the STT paid short-term capital loss first against non-STT gains that is taxable at 30% and the balance against STT affecting gains tax at 15%. It shows whether a short-term capital loss on which STT was paid can be set off first against the short-term capital gains not subject to STT, that is tax at 30%, or whether it must be matched with gains taxable at the same rate 15% as per section 111A or 115AD and section 17 subsection 2. Let's see what tribunal observed in section 70 subsection 2 allows set off of short-term capital loss against income under a similar computation under sections 48 to 55. These provisions do not refer to the rate of tax. That is very important. It is not whether the it is taxable at 30% or 15% or 20%. What is important is the type of the income of the head, type of the head. It is already in a short term. Whether it is taxable at 30 or 50, it is another only to a computation method. What section 70 allows set off of short-term capital loss against income under a similar computation under section 48 to 55. These provisions do not refer to the rate of tax, only to the computation method. Tribunal cited coordinate bench rulings, iShares MSCI AM UC ITS ATM USD SSC versus DCIT Mumbai Tribunal and Calcutta High Court in Rangmati Trexin, which held that STT paid losses can be set off against non-STT gains as both are computed under the same sections 48 to 55. So, rightly, STT paid losses can be set off against non-STT gains. The AO and DRP period in insisting on the rate-based hierarchy of set off. The correct approach is based on nature of computation, no STT status. The tribunal allowed grounds 1 to 4 relating to set off structure and revised the capital gains computation in favor of the assessee, directed that the assessee's method of rating of STT paid short-term loss first against non-STT gains is valid under section 70 subsection 2. Ground regarding interest under section 234 C and penalty under section 270A were dismissed or untreated as premature. Appeal was partly allowed by the tribunal in order 23rd May 2005. Means that is related to STT of short-term paid to non-STT short-term. Means STT paid short-term loss can be adjusted against non-STT paid gains. Vasant Nagarov Barbade versus DCIT ITA number 5372 Mumbai 2024 relevant assessment year 2018-19 date of order is 22nd May 2025. Relevant sections are section 54F and 56 subsection 2 clause 10. Let's understand facts and issue of the case. Return filed on 15th August 2018, total income declared at 61,34,000 is selected in limited scrutiny due to undervaluation of property. Assessee and his daughter surrendered tenancy rights in a redevelopment scheme and were allotted a flat by developer via permanent alternate accommodation agreement dated 21st September 70 with nil monetary consideration. Stamp duty value is rupees 2 crore 88 lakhs. AO treated allotment as a receipt of immovable property without adequate consideration and added entire stamp value of 2.88 crore to assesses income under section 56(2) clause 10 subclause B capital B since no price was paid. Issue was whether surrender of tenancy rights followed by allotment of flat for no monetary consideration is a capital gains transaction, section 45 or 48, or income under section 56, subsection 2, clause 10, and whether deduction under section 54F is available if capital gain reinvested in the new flat. Let's understand what tribunal observed and held. Tribunal held that surrender of tenancy rights qualifies as a transfer of capital asset, absolutely, attracting capital gains under section 45, read with section 48, even though no cash changed hands. Even though cash changed, even though no cash is there, no cash changed hands, then tenancy rights, surrender of tenancy rights should be qualified as a transfer of capital asset. Relied on Supreme Court decision in CIT versus DP Sandhu Brothers Chembur, affirming that tenancy rights are capital assets. Tenancy rights are capital assets. Once income clearly falls under the head capital gains, so once income clearly falls under the head capital gains, it cannot be taxed under income from other sources via section 56, even though section 56 may seem applicable. Tribunal found that the flat allotted truly belonged to the daughter and the assessee's inclusion in agreement was administrative. Surrender of tenancy gain belonged in daughter's hands. However, even if treated in assessee's hands, since full stamp value was reinvested in the residential flat, Section 54F relief is available. The assessee and daughter had not claimed an exemption under Section 54F in return. Tribunal nonetheless permitted claim based on appellate authority power under Boett's India Limited versus CIT, allowing new claims if facts are on record. Means they are not claimed at the time of filing the return. So whether they are eligible to claim while in assessment or such like things. So what tribunal says that it's permitted the claim based on the appellate authority power, allowing new claims if facts are on the record. Facts should be on record. Addition under section 56 to 10 against the assessee is deleted. Tribunal treated the surrender of tenancy rights as a capital gains event. Tribunal treated the surrender of tenancy right as a capital gains event not chargeable under section 56 and therefore directed the deduction under section 54F should be allowed for the capital gain because now it is treated as capital gain. So the deduction under section 54 is absolutely available as a full reinvestment offered. Grounds raised by assessee allowed, appeal allowed, and remanded for appropriate relief. Next, ITO versus Sign Up Land Developers, ITA number 441, Ahmedabad 2020. Relevant assessment year is 2015-16. Date of order 31st December 2024. Let's understand facts and issue of the case. Yes, before going to the case, stay tuned till the end of the video as we will going to discuss one-liner conclusions that can be drawn from today's discussion. So it will be very important for you. You can take the screenshot of it and keep it with you for future reference. Okay, let's start. Facts and issue. Partnership firm filed return on 24th September 2015, declaring income of rupees 4,68,000 for AY 2016. Case selected for cash scrutiny. AO noted opening work in progress balance of 6 crore 47 lakhs and total sales of 4 crore 20 lakhs, but P&L account recorded sales of only 55 lakh 70,000. The difference was attributed to undisclosed sales. What AO noted is that opening WIP balance 6 crore 47 lakhs, sorry, in total sales of 4 crore 20 lakhs, but P&L account recorded the sales of only 55 lakh 70,000 and the difference was attributed to undisclosed sales. Issue was whether AO was justified in disallowing the assessee's accounting method, percentage completion method, and making an addition of 4 crore 20 lakh, 4.20 crore based on actual sales, causing double inclusion despite the method being consistently applied in earlier years. Let's see what tribunal observed and did. Assessee followed PCM consistently, right? Percentage completion method. Revenue recognized on approval basis over the period of project, not at point of sale. How revenue is recognized on approval basis over a period of project and not at a point of sale. No defects or inconsistencies were pointed out by the AO in books. AO's addition based on full actual sale amount resulted in double taxation since profit parts had already been offered in earlier years under PCM. Tribunal noted that once a method of accounting is regularly followed and not shown to be a defective, it cannot be altered arbitrarily by AO without valid reasons. Tribunal allowed the appeal in favor of the assessee, setting aside addition of rupees 4 crore 20 lakhs, held that percentage completion method was a valid and consistent method. AO could not override it absent material flaws or specific errors. The addition was not sustainable as it led to double addition of income. And now we are moving to the High Courts. Cases reported to High Court. First case. MS VSVS Projects Private Limited versus State of Telangana 2025 474, ITR 306, Telangana High Court, 11th assessment year is 11/12. Date of order is 30th January 2024. Relevant section is section 276B. Let's understand what was the issue of the case. Here, under the cases reported to High Court, we are going to directly what was the issue, and not we are not discussing facts, but directly what was the issue, whether criminal prosecution under section 276B for delay in depositing TDS with the government is justifiable when the entire TDS along with the interest was eventually paid before the departmental action or objection. Delay was explained due to financial distress or crisis of the company, and prosecution was sanctioned waived after more than 3 years since the delays occurred. Let's see what Telangana High Court observed. The court noted that although TDS was delayed on 39 occasions, the assessee eventually paid all the tax and interest, and the department accepted the amounts without objection. The delay was submitted to genuine crisis in the company. There was no evidence of malified action, malified intention, fraud, or intentional evasion on the part of the assessee. The sanction for prosecution under section 276B was granted 2 years and 9 months after the departmental notice, and the complaint filed several years later, indicating inordinate delay in initiating the proceedings. It held that at such belated stage, prosecution would not serve any useful statutory or penal purpose, and would rather amount to unfair and oppressive exercise of power. The Telangana High Court allowed the writ petition of the assessee, quashing the criminal prosecution proceedings under section 276B, holding them unsustainable in these circumstances. No cost but prosecution proceedings were terminated. Next, Sanjay Baveja versus DCIT TDS 2025 474 ITAT 376 Delhi High Court, date of order 30th May 2024. Relevant sections are section 5 and 17 subsection 2. Let's see what was the issue. Whether one-time voluntary payment received by an ex-employee in lieu of diminution in value of unexercised ESOPs qualifies as perquisite under section 17 subsection 2 clause 6, and hence taxable as salary income despite lack of exercise of options, and whether the payment constitutes income under section 5 scope of tolling as or a capital receipt not chargeable to tax. What was there are two issues: whether a one-time voluntary payment received by an ex-employee in lieu of diminution in value of unexercised ESOPs qualifies as perquisite under section 17 subsection 2 and hence taxable as salary, and whether the payment constitutes income under section 5 or a capital receipt not chargeable to tax. Let's understand what Delhi High Court observed and held. ESOPs granted but never exercised. ESOPs granted but never exercised. So no shares were allotted to the petitioner under the plan and no determinable value crystallized. In such circumstances, no perquisite arises under section 17, subsection 2, clause 6. Why this perquisite not arises? Because ESOPs granted but never exercised, so no shares were allotted to the petitioner. The payment in question was a one-time voluntary indemnification by the employer to the compensate for loss in value of unexercised options and not tied to employment or exercise of the rights. Perquisition under section 17 subsection 2 clause 6 requires when it requires exercise of option for valuation about exercise, the payment cannot be taxed as salary or perquisites. The payment cannot be taxed as salary or perquisite. The payment instead is a capital receipt, not taxable under section 5, and the petitioner properly sought a nil TDS certificate under section 197. The departmental rejection lacked statutory support. The High Court allowed the writ petition against the order, rejecting the Section 197 application. It held that voluntary compensation doesn't fall within salary or perquisite under Section 5 and 17, subsection 2. It is a non-taxable capital receipt. It was what? Non-taxable capital receipt. Order the revenue to reconsider nil TDS application and permitted the petitioner to apply for refund of any tax withheld. Next, Deputy CID versus Asian Praxim Private Limited, 2025, 474 ITR, 25 Delhi High Court. Relevant assessments years are 2004, 5 to assessment year 11, 12. Date of order is 20th October 2024 and relevant sections are section 245C, 245D, subsection 4 and 245H. Let's see what was the issue. Whether the Income Tax Settlement Commission evaded in granting immunity from prosecution and penalty under section 245H when a portion of the settlement computation under section 245D7 was based on unreliable data, that is consolidated accounts not audited. The immunity was granted despite concerns over accuracy of disclosure and financial records, and the revenue only challenged the immunity component, not the computation of settlement liability itself. What revenue we challenged is immunity component. Let's see what Delhi High Court observed. The ITSC rejected both the audited accounts and consolidated accounts prepared for the SEC due to serious discrepancies and disclaimers by auditors, deeming them unreliable for computation of income. A joint verification of all original primary documents was ordered instead. Under Section 245D subsection 4, the ITSC is empowered to pass orders on matters covered by the application as well as other matters relating to the case based on reports from the commissioner, granting scope for broader inquiry beyond the figures disclosed in the application. The High Court held that full and true disclosure and cooperation before the ITSC are the twin statutory preconditions for both valid statement computation under Section 245D, subsection 4, and discretionary grant of immunity under Section 245H, subsection 1. Where both conditions were satisfied, the court found no legal basis to sever the computation aspect from the immunity grant if the same disclosure made Section 245D, subsection 4, it must equally satisfy Section 245H. It further emphasized the finality of settlement commission order under Section 245 and observing that the partial challenge to the immunity decision while leaving computation intact would undermine legislative intent and integrity of settlement proceedings. The Delhi High Court dismissed the writ petition filed by the Revenue, upholding that ITS's decision to grant immunity from penalty and prosecution under Section 245H. It ruled that immunity is not severable from the substantive settlement computation when the same finding of full and true disclosure and cooperation underlies both provisions. No interference was warranted in the ITSC order, as all the statutory requirements of Section 245C, D, subsection 4, and 245H were made and satisfied. Ravi Kumar Sinha versus CIT 2025, 474, ITR 594, Delhi. Relevant assessment years are. Sorry for the interruption. Relevant assessment years are 1997, 1998, 299, 2000. Date of order is 14th August 2024 and relevant section is section 17. Let's understand issue of the case. Whether the fair market value of shares allotted under an employee stocks purchase scheme, that is ESPS, subject to lock-in period and hence no transferable should be taxed as perquisite under section 17 subsection 2 clause 3A, or whether the presence of lock-in restrictions justifies discounting the fair market value for computation of taxable computation. What was the issue? Whether fair market value of the shares allotted under ESV, that is Employee Stock Purchase Scheme, subject to a lock-in period and hence non-transferable, should be taxed as a perquisite under Section 17, subsection 2, clause 3A, that is under salary head, or whether the presence of lock-in restriction justifies discounting the FMV for computation of taxable perquisite. Let's see what Delhi High Court observed and held. The Delhi High Court analyzed whether shares subject to contractual restrictions, that is lock-in period, preventing transfer for specified time should be valued at full FME or with appropriate discount or restricted marketing. What Delhi High Court analyzed is whether shares subject to contractual restrictions preventing transfer for a specified time should be valued at full FME or with appropriate discount for restricted market value. The court held that fair market value must reflect existing restrictions and the price used for taxation of perquisites under Section 17(2), Clause 3A should be discounted accordingly. Attempting to apply the full FMB, ignoring lock-in restrictions would result in an inflated taxable perquisite not aligned with economic reality. What attempting to apply the full FMB will do, ignoring lock-in restrictions, would result in an inflated taxable perquisite not aligned with economic reality. The Delhi High Court ruled in favor of Ravi Kumar Sinha, directing that the valuation of ESPS allotted shares subject to lock-in restrictions must be calculated after applying a discounting factor. Accordingly, the taxable perquisite under Section 17, subsection 2, clause 3A for assessment years 97, 98 to 99, 2000 should be computed with reduced FMV, reflecting restricted liquidity and transferability. Next, Principal CIT versus INS Finance and Investments Private Limited, 2025, 475, ITR 83, Delhi High Court. Relevant assessment year is 11/12. Date of order is 30th May 2024, and relevant section is Section 56, subsection 2, clause 8. Number of cases we have discussed today on Section 56. Issue was whether interest received by an assessee on refund of auction money after a court order cancelling the auction qualifies as income from other sources under Section 56, subsection clause 8, that is interest and compensation or enhanced compensation, or should instead be characterized as a capital received, not taxable. Very much important case law. Let's see what Delhi High Court observed and held. The amount in question was interest received pursuant to court-directed refund of auction deposit, not as computation for breach of under agreement. The assessee was the successful bidder whose sale certificate was cancelled by court order. Section 56, subsection 2, clause 8 only taxes interest on compensation or enhanced compensation, not interest on bona fide refunds of amounts legitimately belonging to the assessee. Supporting precedents including CIT versus Saurashtra Cement Limited and Principal CIT versus Power Infrastructure held that interest received in such circumstances is of a capital nature, not chargeable under Section 56, subsection 2, clause 8. Means it was held in favor of assessee that it is treated as a capital nature. Delhi High Court dismissed the revenues appeal, upholding the tribunal's finding that the interest received is a capital receipt, not taxable under Section 56, subsection 2, clause 8, and the amount was not income from other sources and thus not assessable under Section 56, subsection 2, clause 8, or tax in the hands of the assessee. That's it. And now we are moving one-liner conclusions that can be drawn from the cases discussed above in today's session. Let's see one by one. Technical lapses, that is clerical inadvertent. Technical lapses like non-filing of 68 cannot deny immunity under section 278AA when substantive conditions are made. A wrong section claim, that is 54 instead of 54, that is clerical error, doesn't defeat exemption if substantive eligibility and evidence exist. Gifts on the occasion of marriage, that is here, what is important is the connection. Gifts on occasion of marriage remain exempt under section 56, subsection 2, clause 7, despite post-ceremony clearance of checks as intent governs timing. Agricultural land falls within what? Immovable property for section 56, subsection 2, clause 10, and disputed stamp duty valuation requires mandatory DVO reference. Set of under section 70, subsection 2 is based on computation method, not tax rate method, allowing STT paid losses to offset non-STT gains. Surrender of tenancy rights resulted in capital gains. Surrender of tenancy rights results in capital gains, not under section 56 income. An exemption under section 54F applies on reinvestment. AO cannot discard a consistently followed PCM, that is percentage completion method, without defects, as doing so causes unjustified double taxation. Prosecution under section 276B is unwarranted for deleterious payment when due. When dues with interest are fully paid and no mala fide intent exists. Very simple. Voluntary compensation for unexercised ESOPs is a capital receipt. Voluntary compensation for unexpected ESOP is a capital receipt, not a publicity, and is outside section 17, subsection 2. Immunity under section 245H cannot be served from settlement computation under section 245D, subsection 4, when full and true disclosure is established. ESP's shares under lock-in must be valid at discounted FMV for perquisite tax, reflecting restricted transferability. Interest on refunded auction deposit is a capital receipt and doesn't fall within the section 56, section clause 8. Very important. Interest on refunded auction deposit is a capital receipt and doesn't fall within section 56, subsection 2, clause 8. Thank you so much for patient hearing. This is my contact details. Please note down it. If you have any questions, observations, suggestions, do let me know. So we will meet soon in next video series. We have already started 3 video series, 2 related to what law says under income tax case laws, and the second one is GST case laws we discussed, and the third video series is going on GST relearn for every one of it, because what law says is particularly focused for the practitioners, litigation practitioners, those who are dealing with litigation practice. But GST Relearn video series is for every one of us to understand the basic concepts of GST and from basic to advanced levels too. So stay tuned with the Tax Guru YouTube channel. If you are not yet subscribed, then do subscribe for latest updates like this. So be there, be updated, and have a nice day. Hare Krishna.